financial news. We're bringing you The Open, 15 minutes of the top headlines every weekday morning. So let's get right into it as August just keeps hurtling by. Futures on the rise as stocks look to build on gains from Wednesday's session, which ended a stretch of 3 consecutive down days for the S&P 500.
Hi, Ann. Can you believe it? We're back in another slump right now across the markets. And depending on what happens on Friday, things may not get better because investors are, of course, awaiting Federal Reserve Chairman Jerome Powell, also known as JP, his address from Jackson Hole this Friday, where he is expected and to deliver clues on the central bank's interest rate outlook and, of course, its next move. I think it was earlier this week where Philadelphia's Fed president was saying that they were going to stay on their aggressive monetary tightening path. I mean, what are your expectations at this point?
Corey, it's a big one tomorrow, so I'm going to be watching, I think, real time as that speech comes out. It is so interesting that Jay Powell has now said repeatedly, or I should maybe call him JP, Corey, to your point, that the Fed is going to be data-driven and responsive to the new information coming out. So where I'm thinking about it is I am expecting 75 basis points still because inflation data is still so strong. But Corey, I just wanted to read out a quote from Jan Hatzius, who's the chief economist at Goldman Sachs, whose work I do follow. And he has said that in expectation of tomorrow, quote, I think he will lay out a case as he did in his last press conference for slowing the pace of increases. We had 2 75 basis point moves. Our expectation would be, barring significant data surprises, that the September move is 50. So there you go. Chief economist at Goldman Sachs, Corey, who's a little more optimistic than I am, thinks the next move is 50 basis points.
I actually agree with you. Jan Hatzius is one of my favorite chief economists at any bank. He's a very mellow guy, though, in general. But the fact that he's kind of, parting ways with what the Fed sentiment is around 75 basis point and saying he doesn't see it being that aggressive this time around is very, very interesting.
Interesting and possibly good news for tech, right, Corey? Because those have been the most sensitive stocks to these big rate hike increases so far. And speaking of which, some of them do need, Corey, a little bit of help, because as we look at the day's trending headlines, let's talk about Peloton. You and I have talked about that in the past. Peloton shares plummeting right now, Corey, as the company misses on both earnings and revenue estimates. The company has cited waning demand for at-home workout machines. Just as a side note, Corey, we've seen a couple of these work-from-home stocks struggle. We saw Zoom actually seeing a big sell-off over the last 7 days. But the new CEO of Peloton, Barry McCarthy, plans to turn the company around with new strategy implementations such as hiking prices, outsourcing production, and a recent Amazon deal listing Peloton products on Amazon's platform. And Corey, I have a really clear memory of you and I having a conversation on The Open at one point around whether Amazon was going to push into the at-home fitness space. So it looks like they're doing it maybe just a different way.
Yeah, they're definitely, sometimes it's easier, right, to just go with a product that's already put together and built that you can partner with, or if it comes to it, acquire. But Peloton, this is just a mixed bag of a hot mess, people. That's a technical term, by the way, and this is a stock that in pre-market today, currently as we speak, down 15%. It's been down as much as 17.5%. It's down 90% in the past year. It's like Peloton can't get right if it wanted to. And not to mention, I can't remember if it was earlier this week or last week, they were also throwing that idea of being like a IKEA-ish version of Peloton where you put the bike and the tread together yourself. And I'm like, well, where do they do that at, Peloton? So, and then the Amazon news came out. So now I really think if you're like a Prime member and you get your bike delivered in 2 days, you're going to have to put it together. And that thing is heavy because I got one, so I can't even imagine what it's going to take. But the stock, it is all over the place for Peloton.
Peloton too, just one comment I would make, Corey, on this, and love your perspective, is Turnarounds are really hard to do in practice. It takes getting a whole organization galvanized around a vision, making really tough decisions, moving quickly, and sometimes you have to incur bigger losses and spend more to get that turnaround done because there are lots of short-term costs. Turnarounds for public companies are particularly hard because you're doing all of this in plain sight, and the market tends to not be very forgiving. So I don't know, Corey, I think it's going to be a rough ride for Peloton for a while. Turnarounds are tough.
I actually loved your pun too. It's going to be a rough ride for Peloton.
There we go. Ba-ding. Totally unintended, but there we go.
But I loved it. It worked out perfectly. All right, and to return our attention to chip maker, NVIDIA, primarily those GPUs, those graphic processing chips that they make. Well, the company actually missed on both earnings and revenue estimates, citing lower demand for the company's gaming products. This comes, though, after NVIDIA warned us, this is back in August, or earlier, this is still August. Oh my God, where's the time gone? It's still August. They warned us on August 8th that they would experience a slowdown. Now, remember, there have been a lot of production delays and issues around the global supply chain. This is obviously something that has hit not only NVIDIA, but many companies across several different sectors. I will say it's not as though their stock was hit exceptionally hard by this earnings. You're only seeing it down about 2% in pre-market trading. And look, this is still a company with a $429 billion market cap. So saying all that to say, all hope is not lost at this point for NVIDIA.
Stock down, though, 42% so far, Corey, since the start of the year. I looked at the story and I asked myself a different question. Why is gaming down? Is it because everyone's getting back out there? Is this part of the rise of experiential and people going outside and getting outdoors again?
As someone who is not necessarily a gamer, I'm not sure, but that's a very good question. And perhaps you guys just aren't picking up. Well, because I read earlier today that Sony was coming out with like a VR PlayStation headset, two things. I was like, oh, maybe gaming is still alive and well. I don't know because I'm not a hardcore gamer. But I mean, you guys let me know with your emojis. Are you still gaming or are you not? Who knows at this point?
I saw a lot of money bags on there and hearts. So
they're gaming.
It looks like
it. Gaming.
They're gaming. Folks are gaming. They're gaming. Let's chat Amazon a little bit, Corey. Just always something in the news for Amazon, right? Amazon is calling it quits with Amazon Care, the telehealth service that it had rolled out. Amazon Care launched in 2019 and offered virtual urgent care visits and in-home visits virtually. Management expressed that the service was not a complete enough offering for the large enterprise customers, and it wasn't going to work out long term. So Amazon is shutting down Amazon Care, Corey, at the same time as it's bidding on Signify, which is the home healthcare business, and at the same time it's going to be buying One Medical. So what do we make of all this?
That Amazon is still trying to figure out its best way to do what it does best, which is dominate markets. And I think they're understanding that healthcare is very complex and they really aren't sure what's going to be the best play for the company. However, they are trying to throw as many different things at the healthcare system wall to see what sticks and makes the most sense and will easily integrate into their current business model, which is why, of course, they threw their hat in the ring against some other behemoths in the healthcare space with the Signify deal. So we'll have to see how that really plays out in the future. But Anne, can we talk a little bit about Tesla? So yesterday, I did bring this news to the people, our lovely audience here on Public, that Tesla's stock split was going to happen after the markets closed yesterday. And I am happy to report that it did go through yesterday. The split gives Tesla shareholders 3 shares versus 1. That was a 3-to-1 stock split that occurred. I know many of you, I see the money bags. Okay, guys. So, yeah, you guys noticed in your portfolio too, that 3-to-1 stock split. So that brings that 3-to-1 stock split. The total value of shares remaining, though, unchanged. So let me just break this down. If you own 1 share of Tesla, of course, now you have 3, but this is still fractional ownership, so you have a fraction of a share. The same mathematics applies. And I'm sure we have a nice little quick tutorial video all around stock splits within the Public app as well.
Well broken down, Corey. And the key thing here as we go through your mathematics, right, is the overall value of the company has not changed. Stock splits do not create value for a company.
No, they don't. But it can make you look like you own more shares if you just take a quick glance in your portfolio.
That's right. Should we talk about GameStop, Corey? Just speaking about gaming and speaking about tech and just everything all over the place. Just GameStop, so interesting, has announced it's shifting focus back to brick and mortar as the retailer awards stock options to store leaders. The strategy is focused on employee retainment and consists of $21,000 vested over 3 years. The company plans to invest, Corey, between $45 to $50 million in the plan, and management expressed that e-commerce is still a focus for the company, but the store fleet still remains critical to GameStop's value proposition. So, all over the place. Interesting to see how that one pans out.
Oh, GameStop, the meme stock that just will not go away. It just won't. But guys, we don't have much time left before the markets open, and Ann and I, we've got to get through some earnings that have happened, starting with the retail companies. Remember, we talked about the likes of Nordstrom and other companies earlier this week. Macy's reporting their earnings. Well, Dollar General and Dollar Tree, you guys know I'm a big Dollar Tree fan, even though they did raise the price to $1.25. Well, both of these companies beat on earnings and revenue estimates, citing increased traffic and demand for lower cost items in a time of high inflation. Dollar General specifically raised its guidance for the year, but Dollar Tree did miss on earnings guidance estimates, citing inflationary cost pressure, something they'll probably be dealing with throughout the rest of the year. And sticking with retail, but moving a bit more over to fashion, Abercrombie & Fitch shares diving today as the company misses on both earnings and revenue estimates. They were citing as well inflationary pressures. The company did cut its full year guidance with expected macro headwinds to continue, Anne.
And Burlington Stores feeling similar pain, Corey, reporting lower than expected earnings guidance, also citing inflationary pressures on middle-income consumers specifically, as well as a large inventory glut. Burlington reported a 17% drop in same-store sales for the quarter. But on a positive note, Corey, let's round out with Salesforce.
Yes, that company and trimming its full year guidance, but do not be afraid, folks. It did beat on both earnings and revenue guidance. The company also announcing its first ever share repurchase program for $10 billion in share buybacks. So there is a bright spot in this morning's earnings.
Getting the cash back to their shareholders. Corey Hale, as always, a pleasure to have you on. Thank you so much for joining. And folks, that will now do it for today's session of The Open. The opening bell has rung and you're armed with the markets information you need to start what is going to be a busy day. Tune in to The Open on Public Live every Monday through Friday at 9:15 a.m. Eastern for a daily market snapshot. Come back, folks, tomorrow morning, same place, same time. Bring a friend and have a good one.